Morning. So I hope you're all well. This week we're going to look at identifying key structures, flags and flag limits. And before I get started, am I coming through okay? Is the sound loud and clear? I never trust it. Just let me know in the chat if you can hear me okay. Great. And as always, feel free to record this. So last week we started by looking a little bit at the mechanism by which price moves. This idea that it moves, not because there are necessarily more buyers than sellers or more sellers than buyers, but more as a result of the ratio of market to limit orders at any given price, right? In other words, price pushes to the less liquid side of the market. So the question now is, well, which side of the market is less liquid? How do we know where these imbalances are going to occur? Where is the liquidity resting? And, how do we know where there might be an absence of liquidity? And then how can we begin to derive trades from that knowledge? And so we're going to start this week by looking at candlestick charts now that we understand something about what's actually going on inside the candles, okay? So over the next couple of weeks, we're going to put last week's work into a context which will allow you to start taking trades based on this new understanding. Although, of course, I wouldn't recommend taking trades immediately based on what I'm teaching until you've had time to kind of absorb and integrate it. But let's get on with it. So one observation which is common across almost all trading styles is that price shifts between different states. Okay, some people call it trending and ranging, balance, imbalance, impulse, consolidation, accumulation, distribution, markup, markdown. The list goes on. Some of you might have seen this. ICT, the inner circle traders, what he calls the market maker sell model, which is nonsense. And these are just some very basic schematics based on Wyckoff's work almost 100 years ago. So the idea is, base, cluster, block, range, whatever you want to call it, price will spend some time in a relatively low volatility state. Okay. A range, in other words. So, a state of relative equilibrium or balance, and sometime putting in big candles, big moves like these, as an absence of bids or offers. In this case, offers kind of spreads price as it reaches for available liquidity. Okay. And price will move until it finds that liquidity, or until aggressive buyers simply dry up and the imbalance begins to shift, and then price will start moving in the other direction. Okay. And this is what you get, a swing in price. So this is, I think, an hourly gold chart from a few months back, just to demonstrate some of the principles I'm going to be talking about today. So price goes up, price goes down. Now, I'll take you through some of the ways in which we can gauge or have some expectations about the extent of a move like this in more detail in the webinar on scale and managing expectations, which will be in a few weeks' time. But for now, we'll start by just focusing on the structure of a swing, like this one here, and what you should be looking for when you see a move like this occurring. Okay. And as I said last week, you'll find price swings like this on every time frame, and they'll always look different, but the behavior of price is generally quite consistent. Okay, so this is the idea. When price is consolidating like this, there's relative stability or equilibrium. So we consider price to be in balance. The buying's not enough to overwhelm the sell side liquidity, which is sitting up at the range highs here, and the sellers, there's not enough selling to break down through the buy side liquidity at the bottom of the range. Okay. But of course, when one side is exhausted or weak, or a large order or orders come into the market, in this case, an influx of buyers, then the market will move out of balance. Okay, the market moves out of balance. So this move here, we might say, is characterized by imbalance. An imbalance which is kind of exacerbated by the liquidity dynamics we talked about last week, some of which are kind of triggered or initiated as a result of market structure. Okay, these range highs being market structure. So it's only an hourly chart, but over time those range highs become basically points of reference for other traders who place their stops up there, or use a break of those highs as a kind of trigger for action, whether that's for puking short positions or buying a breakout there. So the point is, a break of obvious highs and lows, or areas of classical support and resistance can of course act as a trigger for an increase in order flow. Quite basic stuff, but it's important we just make sure everyone's clear on that. And the breakout on gold here a couple of months ago, a few months back now, was a beautiful example of this. So just some perspective, this is a weekly chart, I think, for those of you who don't trade gold, and you can see that gold's been, or had been, kind of trapped or contained, excuse me, in this range for about 6 years before it finally broke out in June, I think it was. And these highs here, which I've delineated with the dotted lines, are what I want to pay attention to here, because although they hadn't been touched in a couple of years, you can see that even on this time frame, they still act as triggers for an increase in order flow. Just to make that clear, this is a 1 minute chart of the day in which price broke those highs. You can see the dotted lines here, and you can see that we got a massive volatility when the highs were breached, as stops got triggered here and here, and breakout traders rushed in to buy this up. And of course, nobody wants to stand in the way of a move like that. So market makers, who are of course well aware of when price starts moving quickly, and or the kinds of areas where big stops are going to be resting, or where there's likely to be an increase in order flow, as I explained, what they'll do is withdraw liquidity from the market. So they'll widen their spreads because, of course, the last thing they want is to be providing sell-side liquidity in an area like this, just above old highs, where there's very likely going to be a large influx of order flow, which would take them offside very quickly. Okay. So make no mistake that major highs and lows are a significant kind of psychological reference points around which traders make decisions. I hope that's quite clear here. What have I got here? Okay. So I'm also going to show you what a move like that looks like on a footprint chart, just to give you, another perspective. So this is Bitcoin, and the level I'm paying attention to here is this 10K high and the day on which it was breached. Okay. And what I've got here is a recording of the footprint as the level broke, so that you can see in kind of real time how the liquidity dynamics change when price breaks that high. So just note first how price is trading on the right here. Relatively slow, relatively efficient. And then watch how the order flow kind of shifts or changes as price breaches these levels. So what I've done here is marked out the exact high here at 9950 or whatever that is, and then the psychological 10K level, which traders will also have had their stops tucked behind. Okay, and for anyone interested, I've got quite a good paper which tries to explain why stops tend to cluster just beyond round numbers and take profit orders just before or below round numbers like 10K. So, for anyone wanting to keep their stop above that high, you can see it getting broken there. Likely a fair few would have just tucked it behind that 10K level instead of the exact high at 9960, whatever. Anyway, what I want you to focus on is, how noticeable the shift in order flows as price breaches those highs. You get a large influx of buyers relative to what we had on the left here. And you'll see when it breaks 10K, a series of stop outs, which is very clear on the footprint because you get a string of zeros on the bid. So there's your buying, 5 million, 6 million, 10K breaks. And there's your stops. A quick flurry of zeros. As I say, that's more than likely stops getting triggered there. And you can see how strong the imbalance is. Everyone gets stopped out. And as a result, price very quickly trades through a really wide range of prices. Anyway, this is really just to demonstrate again the kind of order flow we expect on a break of significant levels. An inefficient move, basically. Any questions about that so far? Just kind of reiterating what we went over last week. All clear? Okay, good. Just feel free to jump in and ask questions if anything's unclear or if you've got questions about anything. So back to this price swing in gold. Excuse me. Okay, so price breaks out, we get an imbalance. And as price moves up, it's inevitably going to hit some pockets of liquidity on the sell side and stall, find brief balance before either reversing or moving up higher. Okay, so as price moves higher, what happened is it hits pockets of sell side liquidity. It stalls there while it consumes that liquidity, and then either it will reverse or it will continue on up. And remember, the premise from last week was that when price moves like this, when it's kind of out of balance, it tends to overshoot. And when it overshoots, it leaves a vacuum of bids in its wake. So here, for example, you get a really illiquid move, and a candle like this, or in this case, a series of candles, that tells us quite a lot. It tells us that although prices hit liquidity here, okay, because it's stalled, there are also bids willing to chase. Okay, because if bids hadn't come in down here at these lows, likely price would have very quickly reversed, or drawn back right down to the base here, back down through that illiquid move, likely on very little selling as a result of the fact that there were no bids there because it's an illiquid move. So the point is that after an illiquid move like that, candle or series of candles like that can tell us quite a lot. They tell us that buyers have stepped in there, okay? And so for me, this low is somewhat of a line in the sand, a point in the chart where we know that buyers have been willing to step in or to chase prices higher. And I've got an example here to show you, just so you've got a more kind of visual understanding of what's happening here. So on the next slide, I've got a video. And the video is a recording of this price action here. Okay, so this is a 1 minute chart, and the video I'm about to show you is what happens in the formation of this candle. And what I'm really wanting to pay attention to is this area here. Okay, on this time frame, it's just a wick, but you can see this is a kind of similar structure to the structure I just pointed out on gold, right? You get an illiquid move, price pulls back, likely it's hit some sell side liquidity at the top here, it pulls back and stops here before moving on high. So we know that bids have been willing to step in here. Okay, right, so I'll just show you this clip. Okay, so this is a heat map, and all that is, as I explained last week, just a visual representation of the order book. So the kind of white or cream is buy limits, and the blue, I think that is sell limits. So liquidity in the book, and in this case, the more dense the liquidity at a particular price, the more intense the color. So you can see here you've got some sellers up in here, some at 8292, and then bids chasing price up at 8283.5. Supporting price just below market. So you can see price starts pushing up, hit some sell side liquidity, which is either pulled or consumed. Bids chasing price, and then all of a sudden you get a very illiquid move. Okay, very illiquid move, and you can see that 8316, 8312 area is the first kind of price or range of prices at which bids are willing to step in. Bids are chasing price, but only up to that level, and above that you've got a void basically. And so when price pulls back, wicks down to that area, and that's where it finds support. So it's the bottom of this candle which is important for me when I'm looking at a candlestick chart. It's those nuggets or pauses in price which often just show up as single candles on a chart, or even wicks in this case on that 1 minute chart, which represent to me pockets of liquidity, bids which were willing to chase price higher. Okay, so liquidity which is drawn up with the market. Can everyone see that? So this right here is the bottom of this wick here, and you know, it's when that breaks that you get the retrace, and this candle gets filled in. Does everyone understand what I'm on about? Okay, good stuff. So back to gold. So, you know, as price moves up, buyers chase, okay? And this is how I view these little pauses in price, okay? So, you know, let's say you had 100 buyers waiting to get filled in this area here. Let's just clear this up a bit. What happens on a run like this is some of them will remain sitting down in this range, okay? More patient, often kind of longer time frame traders. More impatient or aggressive traders will chase price up either at market or you know, they'll chase with limit orders, okay? And the lows of these kind of pauses in price, these small consolidations, represent areas where bids have been willing to chase, okay? Where liquidity has been drawn up with the market. And, you know, as it moves higher and higher, some of those bids are, of course, unwilling to chase price higher, so they'll stay sitting in those areas. And what happens eventually, price will run into sell side liquidity significant enough to stop price from carrying on up in here, you know, some level off to the left. or buyers will simply dry up, leaving price kind of trapped between two pockets of liquidity, okay, until one side gives way. So what you've got here is a running price. Price hit some significant sell side liquidity. It stalls while it consumes the liquidity in this area up here, and the buy side liquidity, residual buy side liquidity in this area here, until one of those areas kind of gives way. Okay, so it's at this point that you get what you might call a flag. Okay, and people will slap all kinds of patterns on these structures, but in essence, it's an area of consolidation which lasts as long as its limits contain enough liquidity to satisfy both buyers and sellers. Okay, this range will continue until the residual liquidity in this structure here gets consumed, or the sell side liquidity up at the top gives way or breaks. Okay, and then price will carry on up. So today, I mean, this is really the structure I want to focus on. Imbalance, flag limit, price flags out on top of it, okay, until either the sell side liquidity gives way or market sellers overwhelm the residual buy side liquidity, which is kind of chased price up, and which is represented by this small consolidation or cluster of candles here. So you might have seen these schematics before. This is Wyckoff again. But you can see that he observed the same structure almost 100 years ago. Okay, in this case, it's a move down, but this here's your flag limit, which he called the preliminary support, the structure which holds price down after the selling climax until price has finished flagging out, and it finally breaks through here. Okay, which he called a sign of strength. So there's your flag limit, price flags out, and price shows strength when it breaks through that flag limit. And the same in reverse. Okay, again, there's your illiquid move, flag limit. Okay, bids which have been willing to chase price higher, price flags out, and finally the bids here give way, and sellers start chasing price down. Okay, and our premise for a trade here is that this leg is weak. Okay, as a result of the way in which it moved, it's illiquid, and it's therefore vulnerable to a retrace if and when bids dry up, or, as I say, sellers step in here and overwhelm those bids which have chased price up. So some people might look at something like this and see, I don't know, a bull flag or some other continuation pattern, and I'll often take continuation trades off a structure like this, depending on context, because it's it's essentially support, that flag limit, and I'll come onto that in the coming weeks. But the reality is that the higher price gets, the faster it gets there, the weaker it is, and the more likely it will just come crashing back down again. Okay. So, in this sense, as I explained last week, it's often when price looks most bullish that it's actually at its most bearish. And as I say, misunderstanding the liquidity dynamics responsible for a move like, Bitcoin up at 13K, and you end up either lacking the confidence to short or buying the top. Anyone confused about any of that? Okay. So, having a clear understanding of eliminates the need for indicators or for kind of mechanical rule-based systems based on patterns, which are both, of course, just derivatives of the liquidity dynamics, which manifest as price action. So, an ascending triangle, okay, for example, typically bullish pattern is worthless without context. Is there liquidity resting just above those highs, for example? What's holding that structure up? Has it been consumed? They're all really important questions because there are so many variables to take into account when you're assessing a structure like that. Anyway, the point I'm trying to make is that you can't rely on patterns like that without an understanding of the liquidity dynamics in and around price. And if you don't have the ability to distinguish between a pattern like that occurring one time and the next, then you'll find yourself getting confused and frustrated. And of course, it's those emotions which snowball and have you taking trades motivated by revenge or other facets of your mind, which inevitably kind of end up taking a heavy toll on your expectancy. So rather than looking for recurring patterns, we're looking to actually read price. Where is there liquidity? Has it been consumed? If so, where can I get in? Where is price heading, and how do I expect it to move? And if you've got an answer to all three of those questions, then you can find accurate entries and get in with tight stops. Okay, and if you understand that, you also know how price should move. And so if it doesn't do what you expect, you can get out quickly before taking the full loss. So when I see a structure like this, range consolidation, I'm paying very close attention to the last area of known liquidity, okay, which is in there, the flag limit. That's the structure which is currently holding up price. So when price starts consuming the liquidity in here, 1, 2, 3, 4 tests, each of those tests consuming the liquidity in that flag limit, and failing to push higher, in other words, kind of washing out the liquidity which is supporting that structure, then for me it's time to start looking for shorts. And that's, for me, one of the more reliable signs that the tide is about to turn and price is about to start heading down to seek out buy side liquidity, to satisfy the demand of sellers who've come in up here, and we'll start chasing price down if it begins breaking down. Okay, just like buyers did on the way up. Okay, so this is This is a trade I took on GBPUSD cable a while ago now, just to demonstrate what I'm trying to get across. So there's your flag limit, okay? Price is quite clearly ranging here, and that's the structure which is holding up price, okay? First test, second test, third test comes all the way to the extreme of that flag limit, okay? So at that point, I'm thinking the liquidity in there has more than likely been consumed, and then it breaks here, okay? It gets engulfed. And so at that point, I'm on the lookout for shorts, and you can't see it on this time frame, but there was a really nice level in here on the lower time frames, which I took a short at, knowing that there was a good probability that if price were to start breaking down there, it would more than likely run down through these lows, because there's not enough buy side liquidity, not enough bids up here to satisfy the obvious demand of sellers who've come in at the top here. Okay. I mean, we've got different levels of experience and understanding in here, but I'll quickly go over common misconception in case any of you are still under this particular illusion. That is that the more a level is tested, the stronger it gets, and of course it certainly appears that way. We can say for sure that this is support, okay, because price has reacted there 1, 2, 3, 4 times. But what happens each time that area gets tagged? The buy side liquidity gets consumed, and so if you're planning on taking a long off that base, then the highest probability long is to trade the first or second time back, okay, because it's fresh or untested. That's also why we like to look for clean levels, untested levels, because a messy level like this one indicates to me that, as I say, the liquidity in that area has already been at least partly consumed by all this kind of fucking about, all of these tests. Another thing I don't understand, when marking out charts, is why people don't consider wicks important. Because a wick like that is that tells me that the bids in here are depleted, and price has already tested that level there. Okay, so a wick like that's eating into the available liquidity, and so for me that's relevant. It tells us that liquidity in that area has been at least partly consumed. Okay, so I've got a few more examples of this kind of structure, which I'll show you now, just so that you're a little more familiar with what you should be looking for. Because of course this comes in all different shapes and sizes. So again, this is USDJPY. I think it's a 30-minute or hourly chart, again from a few months back. This here's your flag limit, okay, quite clearly the area which is holding up this structure. Price comes all the way to the extreme of it once, twice, and it breaks down through it here, okay. In this case, I took a trade somewhere up here on this false break of the high. Again, knowing that if price was to start breaking down on the lower time frames, it would likely also break down through this level here, and because you've got an illiquid move down here and in here, the risk reward is good, okay. This is gold, I believe. Interesting one here because you've got a kind of fractal. there's your flag limit. Okay, illiquid move, some pause or consolidation in price, which to me, as I say, represents bids chasing price, bids moving up with the market. That level's tested once, twice, 3 times. Price is kind of flagging out on top of it. Okay, there's your flag limit. And then price breaks down. And again, on the higher time frames, you've got the same structure. Okay, illiquid move, there's your flag limit. It's actually broken there, which suggests to me weakness. And then when it finally breaks down, price comes and fills in this illiquid move. This is Bitcoin, this time in reverse, because they've all been, I guess, kind of bearish structure so far. And again, the same thing. You've got this highly illiquid move. Price hits bids here, it stalls, consolidates. This is the area at which we know sellers stepped into, I guess in this case, suppress price, because if they hadn't stepped in there, likely price would have very quickly retraced that move. Okay, so that's the area we know we have sell limits. That's your flag limit. Price flags out below it. Tested once, twice, and then when it breaks through, price has no trouble filling in that illiquid move. And Bitcoin again. Another kind of fractal example here. This is an illiquid move. Okay. There's your flag limit. Price flags out on top of it. Not so clear on this time frame, but on a lower time frame, that would have been quite clear before breaking down. And then you get this larger structure here. So there's your flag limit. Quite clearly the structure which is holding up this much larger structure, tested however many times, and then inevitably price breaks down through it. And just to demonstrate that this happens in every time frame, this is I think a 10 tick chart. So each candle is 10 trades or transactions, and you see the same thing. An illiquid move, okay, an absence of offers, spreads price. Here we know bid stepped in. This is your flag limit. Quite clearly the structure which is holding up this range of consolidation, and then when it breaks, price fills in this illiquid move. Okay, so I know this is quite kind of specific, but the way I've structured this course is that we'll cover different kind of aspects of price or price behaviors, and then put them all together to kind of build a comprehensive model of how price moves. So now that I've given you a brief introduction to flag limit and why it's a good thing to identify when looking at a price swing like this, it would be really good, I think, if you could go and find a load of examples of this in a chart. So whatever it is you trade, just find as many examples as you can of this structure on various different time frames, and just see what you notice. Take screenshots and write down any observations about price. So things which look familiar to you based on what I've covered today, and also anything which doesn't align with what I'm saying here, or things which are still confusing to you. So yeah, just take screenshots, stick them in a folder so that you've got a library of examples, and then we can go over them together when we meet one-on-one. Okay. So that's it for today. Does anyone have any questions? Okay. I hope that was useful to you. Next week, I'll go into more detail about entries. So I will talk a bit more about variations in this structure, entries, you know, how and where to get in, and we'll go over some more kind of practical examples of how I mark out charts as a swing like this develops, and you know, talk a bit more about how to actually get onto taking trades based on this kind of framework we're starting to build here. Okay, no problem. So I'll send out the recording of this later on today if anyone wants to watch it back, and I'll also send out a need to meet form. So if you want to meet next week for whatever reason, then you can book a time there. Okay. But in the meantime, I hope you have a great weekend.